Good morning and welcome to TOI Japan Market Radio for Monday, December 23, 2025. I'm your host coming to you from Tokyo, and this is your daily briefing on Japanese markets tailored for global investors tracking exposure to Japan. Joining me today is our portfolio manager who focuses on Japan macro and equities. Let's dive straight into today's session.
Thanks for having me. Today's trading showed some interesting divergence across Japanese assets. The Nikkei 225 closed at 50,412.871, up 0.021%, essentially flat, while the TOPIX had a much stronger showing at 3,588, gaining 0.985%. The Mothers Index added 0.385% to 2084, and J-Rights pulled back slightly, down 0.22% to 2040.5. On the currency side, USD, JPY fell 1.028% to 156.055, so we saw meaningful yen strength today. Gold in yen terms surged 3.538% to 16,680, and crude oil edged up 0.207% to 58.13.
That's quite a spread between the Nikkei and TOPIX performance. Before we unpack that, let's turn to one of the standout stories from today's session. The Nikkei 225 actually posted a strong intraday rally of 1.81%, and one name really drove that move. Sumitomo Electric Industries surged 7.27%. That's a significant single stock contribution. What's behind this surge and why should global investors pay attention?
Sumitomo Electric is a heavyweight in Japan's industrial complex, spanning power transmission systems, automotive components, and telecommunications infrastructure. A 7.27% jump in a name of that size signals something meaningful is happening either at the company level or across the broader cyclical industrial sector. For Japan specifically, this matters because Sumitomo Electric sits at the intersection of several structural themes: energy transition, electrification, and capital goods demand. If investors are bidding up this stock aggressively, it suggests renewed confidence in either a demand recovery for infrastructure and industrial capex, or perhaps company-specific catalysts like new orders or project wins.
And what does that mean for the broader equity market, particularly the Nikkei and TOPIX?
The 1.81% intraday gain in the Nikkei reflects solid risk sentiment and suggests that money is rotating into large-cap industrials and infrastructure plays. If this move is part of a sector-wide re-rating rather than just a Sumitomo-specific story, we could see continued strength in the Nikkei 225 and broader participation beyond the usual mega-cap tech and export names. For the TOPIX, which is more diversified, a rally in industrials and cyclicals would be supportive, especially as we head into year-end and investors position for 2026 themes around capex and domestic demand recovery. The key question is whether this is a one-off or the start of a broader rotation.
What about the implications for the yen and Japanese government bonds?
On the yen side, equity strength alone doesn't typically create direct currency pressure, but if this rally signals a sustained shift toward Japanese cyclicals and industrials, it could attract foreign capital inflows, which would provide modest support for the yen. For JGBs, equity strength usually puts mild upward pressure on yields as investors rotate out of safe haven assets and into risk. We'd want to watch whether this intraday equity move translates into a more persistent shift away from defensive positioning, which would pressure JGB prices and lift yields modestly. However, structural factors like Bank of Japan policy and demographics still anchor the long end.
Staying with the yen theme, there was another important development today. Global equity markets rallied broadly on festive risk sentiment as we approach year-end, but alongside that, the yen strengthened amid what appears to be official warnings or communication regarding foreign exchange volatility. How do you read this dynamic?
It's a nuanced setup. On one hand, the global equity rally heading into the final trading days of 2025 is a tailwind for Japanese exporters through stronger foreign demand and improved earnings translation when markets are rising globally. On the other hand, yen strength, especially if driven by official intervention warnings or safe haven flows, creates a headwind for export competitiveness and repatriation of foreign earnings into yen. The FX warning component is particularly interesting because it suggests Japanese authorities may be signaling their readiness to act if they see destabilizing moves in the currency, or they're trying to anchor expectations around yen stability as we close out the year.
So how does this dual dynamic play out across Japanese equities, the yen itself, and yields?
For equities, I'd expect mixed to slightly positive performance in the near term. Global sentiment supports cyclicals and large exporters, but yen strength acts as a cap on upside, particularly for the most yen-sensitive export names. Domestic-focused stocks, which benefit less from global rallies and more from local demand, might actually underperform in this environment. On the FX side, the yen is being supported by official messaging, so rather than seeing directional weakness in USD, JPY, we're more likely to see range-bound trading, especially if authorities are flagging intervention readiness. That 1.028% drop in USD, JPY today to 156.055 is consistent with that dynamic. For JGB yields, I'd expect them to remain stable to slightly lower as yen strength and year-end liquidity conditions support safe haven demand, and there's no immediate upward pressure from global reflation concerns at the moment.
On the policy side, we also heard from Japan's Prime Minister today emphasizing that corporate investment is a critical lever for strengthening the economy. This isn't the first time we've heard this message, but it does seem to be a renewed focus. Why does this matter for investors right now?
This is a significant policy signal. Japan's economy has struggled for years with structural issues, an aging population, deflationary pressures, and notably, subdued business investment despite the fact that Japanese corporations are sitting on very strong balance sheets. If the Prime Minister is publicly stressing capex as a growth driver, it suggests the government wants to shift the economic recovery narrative away from reliance on fiscal stimulus and monetary accommodation toward sustainable, private sector-led growth. If companies actually respond and start deploying capital into productive investment, that could support productivity gains, wage growth, and domestic demand, all of which are critical weak points in Japan's current recovery.
What would that mean for markets if we do see a pickup in corporate investment?
For equities, cyclical and capital goods sectors would be the primary beneficiaries. Think machinery, semiconductors, construction, and industrial equipment. These sectors would see rising order books and revenue visibility if capex picks up. However, the market impact will likely be limited unless we see concrete policy incentives to back up the rhetoric, such as tax breaks, accelerated depreciation schedules, or other measures that actually change the calculus for corporate treasurers. On the yen, stronger domestic investment could provide modest support if it signals confidence in the economic trajectory and helps narrow the current account deficit over time. That said, near-term FX moves are still going to be driven more by U.S. Federal Reserve policy and JPY carry trade dynamics. For JGB yields, there could be marginal upward pressure if capex growth accelerates inflation and narrows the output gap, but the structural factors we talked about earlier, aging demographics, low inflation expectations, and Bank of Japan policy, will likely keep yields range-bound for now.
So it sounds like the investment theme is more of a medium-term story rather than an immediate market mover.
Exactly. It's an important signal of policy direction and could be a meaningful driver of market performance in 2026 and beyond, but for now, investors will want to see follow-through in the form of actual policy measures and then confirmation in the capex data itself before pricing in a sustained move. The messaging is encouraging, but Japan has had false starts on the capex front before, so a degree of caution is warranted.
Shifting back to equities, if we zoom out and look at today's overall session, what are the main themes global investors should be focused on as we close out this week and head into year-end?
I think there are three key themes. First, the divergence between the Nikkei and TOPIX today highlights the importance of sector and stock selection. Broad market gains aren't guaranteed even when individual names or sectors perform well. Second, the interplay between global risk sentiment and yen strength is going to be critical for positioning in Japanese exporters versus domestic names. And third, the policy focus on corporate investment is a longer-term positive, but investors should watch for concrete measures and actual data rather than just rhetoric. Heading into year-end, liquidity tends to thin out, so moves can be exaggerated, and it's a good time to reassess positioning and risk rather than chase short-term momentum.
That's a very clear framework. Any final thoughts on what to watch in the next few sessions?
Keep an eye on whether the Sumitomo Electric move was idiosyncratic or the start of a broader industrial sector rally. Also watch USD, JPY closely. If we see further official communication or actual intervention, that will shape flows significantly. And finally, monitor any additional policy announcements or fiscal measures that might back up the Prime Minister's messaging on corporate investment. Those will be the signposts for how to position heading into the new year.
Excellent insights as always. To our listeners, that wraps up today's TOI Japan Market Radio for December 23, 2025. If you're a global investor tracking Japan or managing exposure to Japanese markets, we hope this briefing has been useful. Consider subscribing for daily updates as we continue to cover market moves, policy developments, and thematic shifts across Japanese equities, currency, and rates. Thanks for listening, and we'll see you in the next episode.